Kerry Baines, UW St. Augustine, MSc Financial Economics. Abstract: Maximizing your high-frequency trading activities. Market trading perspectives. First, learn to look at high-frequency stock market transactions from two aspects, that of the exchange and that of the e-trader, one providing the quote and the other generating profit return from a transaction facilitated by the provider on the global electronic stock exchange. The major exchanges are electronically generated to one of two general scenarios, through a series of electronic communication networks storing the specifics of a transaction. Extending demand market strategies at even multilateral, multivariable replicated contract scenarios. Most of the information in the aggregate supplies liquidity, or i.e. adequate volume at a price that demand for the instrument appreciates exponentially. High-frequency trading scenarios and participants. Participants' desires for appreciating market equity in perpetual economic growth is achieved either through order-driven trader activities providing volume trades and or simultaneously quote-driven buyers choosing options that profit most through exponential regenerative growth. High-frequency trading targets. The volume of transactions are targets provided to traders through formula-driven algorithms, some logarithmic, some non-friction, some BCAC, others autocorrelated, that present a time interval on any given frequency that acts as a decision point realized through exchange modeling implementation. Pinpointing trading strategy models. Determine if news-driven, observation-driven, or parameter-driven suits best. Distinguish multivariable Excel points in a pattern of trading intervals with a rich Bayesian heterogeneous sampling, angle distribution curves, exogenously implemented strategy returns, investment-driven research criteria materializing profits from currency, commodities, and equity exchange transactions. Make sure models use the correct specifications. Time intervals. Accelerating trade through multivariable time generates more frictionless currency appropriation levels, and you have to account for transaction costs at multinational multivariable frictionless levels. Using both variables, systematically start looking for early indicators and study new information's impact on your consumers. A 2-hour time span trading can net low volume traders hundreds of thousands and larger banker dealers hundreds of millions, making time intervals very intensifying as changes in visibility that mirror market cycles provide liquidity timing matches scoring profits. Utilize the mean. The law of large numbers always works. More liquidity is better than none, and in almost all cases, that remains constant. You can trade well determining where the central tendency is, i.e. data after all is human choice, and autocorrelated or not. Anything that tends to happen more than 50% of the time makes you more profits.